Myth number 1, investing in the stock market is too risky. So, are you afraid of losing money in the stock market? Don't worry, you're not alone. Like, everyone has felt this. I have felt this. But here's the thing. Fear could be holding you back from reaching your financial goals. So, while investing can be intimidating, there are ways to manage risk, like diversification. So, instead of putting all your eggs in one basket, we spread them out to minimize losses. Have you ever heard of diversification? It's the secret weapon against financial ruin, essentially. So imagine this. All your money was tied up into one stock, into one company. If that company was to go bankrupt, your investments are gone. Like, your money's gone. And that's the risk of a concentrated position. But by spreading your investments across different stocks, bonds, and cash and other cash equivalents, you're not putting all your eggs in one risky basket. So, what does that mean? That means you don't need to be a stock picking genius to succeed in the market. It's all about finding the right mix of investments that work for you. So, remember, there's no one-size-fits-all approach to investing. It's about crafting a portfolio that aligns with your goals and your risk tolerance. But don't worry, it's really not that hard, and we can absolutely succeed in the market while being lazy investors. That's why you follow me. So, take a look at this graph of the S&P 500 index. So, as a refresher, the S&P 500 index tracks the 500 largest companies in the US at any given time. So, if you invest in an index fund that tracks the S&P 500, you are investing in 500 companies without having to choose them individually. But the S&P 500, like the stock market, can be a wild ride. So it goes up and it goes down, right? And then up and down. So this is driven by economic factors and investor emotions, all of that stuff. So let's just zoom in a bit and see one of these roller coaster rides. You can see one of them happening at the start of the COVID pandemic in 2020. So we see beginning of 2020, the markets tanked, and then a few months later, they soared to all-time highs. Okay. And here's the kicker. If you zoom out, so let's zoom out and look at the graph over the long term. Over 30 plus years, you'll see a clear pattern. It's on an upward trajectory, right? So despite the roller coaster of volatility, the overall trend is growth. So while the stock market can shake things up in the short term, sticking around for the long haul pays off. Like, you can see that it does. So remember, it's not about timing the market, it's about time in the market. And we'll talk a little bit more about that concept a little bit later on in the video as well. All right, let's tackle another myth. Myth number 2. It's safer to keep money in a savings account. Yeah, absolutely a myth. So, spoiler alert, inflation can shrink your purchasing power. So, keeping too much cash on hand might seem like a secure move, but it actually could be shrinking your purchasing power. So your purchasing power refers to the ability of currency to purchase goods and services. So your ability to buy milk and eggs year over year. Inflation, on the other hand, erodes this purchasing power by increasing the general price level of goods and services over time. So essentially, if inflation will essentially mean if you're trying to buy eggs today versus eggs next year, depending on how much the inflation is, you'll need extra money to buy the same amount that you bought today versus what you can buy next year. So let's look at an inflation calculator. Here you can see how much a 3% inflation in 1 year can erode your purchasing power. So if today you bought $100 worth of eggs and there was a 3% inflation, next year, the same amount of eggs is going to cost you $103. So using the Bureau of Labor Stats and their inflation calculator, you can see the impact of inflation using real-time data. So if you had $100 in the year 2000, in 2024, 24 years later, you would need to have $185.03 to have the same purchasing power you had in the year 2000. So that's a lot of money. That's inflation. So have you ever been in a restaurant that's been around for a while and they have like an old menu up on the wall and it says a burger is 50 cents when today it's $10? Yeah, that's inflation. And it can really creep up on you. Inflation sucks, but investing can beat inflation to keep up with the rising prices. So really, not investing is more risky than just keeping your money in cash. So you might think, but wait, isn't investing complicated and time consuming? Not necessarily. That brings us to myth number 3. Investing is complicated and time consuming. Let's debunk that myth. Like the article mentions, investing can be really complicated, but it's only as complicated as you make it. You can build and maintain a diversified investment mix made up of index funds and ETFs. I only spend a few hours a year maintaining my investments. And that's really doing a little bit of tax loss harvesting and rebalancing accounts. And honestly, working in wealth management, I see that my investments are slightly more complicated than most people's, right? Just a little bit more. So it really doesn't take that long to kind of maintain your investments year over year. For the most part, you can set it and forget it. How do we do this? Well, let's copy the professionals, right? That's why you follow me. I'll show you how. Here's an example. If you're 30 years old today and you will retire at 65, that gives you 35 years. This is how Vanguard will invest your money if you gave it to them to professionally manage in a target date fund. They'll invest in 4 funds. They'll invest in the Total Stock Market Index Fund. They'll invest in the Total International Stock Index Fund. They'll invest in the Total Bond Market Index Fund. And they'll invest in the Total International Bond Index Fund. Essentially, they're invested in everything, both in the US and internationally. And if you have accounts at Fidelity or Schwab, you can find their equivalent to these funds to replicate as well. Like, I promise you. You have the skills to replicate this. You have the skills to build a winning portfolio and to create wealth for yourself and your family. Okay, all right, y'all. We've got through 3 of the 7 myths of investing. And this video is getting a bit long according to YouTube's algorithm, which means we're going to cut it here. And we're going to do a part 2 later. So comment below which debunked myth has been the most shocking so far. And thank you everyone for joining me today. I'm having a really, really great time making these videos for you all. Please take it, run with it, and build your wealth. All right, I'll see you next week for part 2. Thank you. Bye.